Hello, I'm Josh Garland, Senior Financial Advisor here at Apriem Advisors. I am so happy that you are joining us for our educational series on annuities. Perfect timing, June being Annuity Awareness Month, and this really helps to push forward Apriem's goal of continuing to push out financial literacy to not just to our own personal clients, but to everyone. So today we're talking about annuities, and we're going to get a little bit more in depth. We'll get a little bit technical, and if you have additional questions after going through this, please, by all means, track us down. You can find us at apriem.com, and you reach out directly. You can talk to any one of our advisors. You'll see me on there. You can even reach out and talk to me direct if you need to. So let's go ahead and get into it. I don't know if you've watched any of my previous videos that have gone out, but we talk about a number of things. Number one, what is an annuity? So this is a great question. It's a great place to start. It's actually kind of a funny story too if I told you how I got into this business. My best friend's dad sat me down one day, explained a role at his business that he wanted me to take over, and he ends up telling me, Josh, your title will be the Director of Annuity Marketing. And I told him very graciously, William, I love you. You're like my second dad, but I don't even know what an annuity is. I've never even heard of that before. I don't know if I could actually spell that for you. And at the time, he laughed. He told me, Josh, you can learn all of that. I will teach that to you. So there's a lot more to that story, but I think that it's relevant because I think I'm not the only person that's out there. In fact, when I told our marketing person that it was Annuity Awareness Month, she actually told me she went and Googled what an annuity is to figure it out at that time. So let's talk about it. At its core, an annuity is a contract between the annuitant, so let's just call it you today, right? So you're going to be the annuitant, you're going to purchase an annuity, and it's a contract where you go to an insurance company and you purchase this annuity contract. Oftentimes people call annuities investments, when in reality, an annuity, it's not actually an investment. It's a contract between you and an insurance company. Okay, and what this contract essentially states is that that annuity at some point in time is going to provide some type of an income stream to you. Now, at the end of a specified term that's in the contract, it might actually say that that form of income that you would receive could be something like a lump sum, right? So you could literally just take all of your money out at the end, or it could be a stream of income that pays you for the rest of your life. This is important when we think about that stream of income feature, right? Because this actually tells us, why are we purchasing this from an insurance company? If you think about any type of insurance that exists out there, what does insurance do? It protects us against some type of a risk, right? I buy car insurance. If I get in a car accident, the insurance helps to compensate me and pay for that accident, right? If I have life insurance and I pass away prematurely, my family receives this income to essentially replace my earning potential that I would have had while I was still here. So with an annuity, what is the risk that's being covered? The annuity is covering the risk of if you were to have held onto those funds yourself and take withdrawals, whether in retirement or over the course of maybe a special needs child's life, right, where those funds could have gotten depleted down to zero. Well, that's the risk, right? We could deplete those funds to zero, mismanage them, whatever it may be. In this case, by purchasing an annuity contract, we're buying income insurance. We're insuring ourselves against the risk of running out of money. Okay, so at its core, that's really what an annuity is. Now, annuities have been shaped to do all sorts of different things that oftentimes are the primary piece that we end up talking about. So let's talk about some of the different types of annuities that exist out there and some of the terminology you might hear. So very, very high level, you'll hear things like single premium immediate annuity, single premium deferred annuity, or flexible premium deferred annuity. So let's start there, broad strokes. If we think about a premium is a payment to an insurance company for an insurance policy. If it's a single premium, it means we're making one payment to the insurance company. If it's a flexible premium, it means that that is built in such a way we can make multiple payments to the insurance company. Okay? A single premium immediate annuity is a contract where we give them one lump sum of cash, and then that policy is going to provide immediate income, typically starting something like 30 days after the policy has issued. Not in all cases, but in general. Okay? The single premium deferred annuity, well, we're deferring how long until we're going to begin to receive that income stream. Okay? Also, one payment goes in. The last one, flexible premium deferred annuity. We're putting multiple premium payments in, or maybe we just want a policy where I can add to it over time if I want to, not that I necessarily have to. And it's also deferred. I'm deferring out when that income will start. Now, we take it to the next level below that. Okay, under these umbrellas, right, we then have what we would call fixed annuities, fixed indexed annuities, and variable annuities. And so these three different types of annuities we're talking about here can also be single premium or flexible premium. If we were to think about the fixed annuity side of things, this is something that pays a fixed amount of insurance. So I'm making this number up. Let's pretend I'm going to buy a fixed annuity that has a 5% interest rate. Very similar to something like we might purchase at the bank if we went to go and get a CD. Now, that fixed annuity can have a different surrender charge schedule or maturity period listed on that fixed annuity. And so let's just say, for the sake of our conversation, let's say it's 5 years. It could be 7 years, could be 10 years, something within that range. Let's say it's 5 years. Now there's two different types of fixed annuities you might run into. You might run into one that says, we will give you, let's say, 7% interest in the very first year, and there's no fluctuations. You just get first year, 7% interest. And then it's going to drop down in years 2, 3, 4, and 5 to a guaranteed rate. Or it might actually have a rate that fluctuates each year after that, which we call a renewal rate, right? So it could be 7% in the first year, and then in year 2, maybe it comes down, and now all of a sudden it's 4%. And in year 3, it's 3%. And then for some reason, in year 4, it jumps up and actually ends up being 5%. That rate can change each year. So that's a typical traditional fixed annuity. They also have in the fixed annuity category what are called multi-year guaranteed annuities, where it will pay that same fixed rate each year. So maybe instead of having some higher rate in year 1 at 7%, maybe it's 5% every year for 5 years, as an example. That's what we would call a multi-year guaranteed fixed annuity. Let's talk about the next category, what we call fixed indexed annuities. Now, fixed indexed annuities are a little different. They are still considered to be safe products in that with a fixed indexed annuity, there's downside protection, typically 0% floor. So the interest that's credited to this fixed indexed annuity contract is going to be credited based off of an external stock market index. The most commonly used index is the S&P 500 index, but it could be others. It could be the NASDAQ, it could be the Dow Jones, it could be a number of different types of indexes that are out there. Oftentimes there's indexes that are specifically created for these insurance companies to utilize when they set up these fixed indexed annuities. So you might hear something that is proprietary to that particular product. What's important to note is that while that stock market index is going to fluctuate up and down, if it ends negative, the fixed index annuity does not participate in that downside. You get 0% interest. You don't earn anything in those years, but you also don't lose anything, which a lot of folks can like. What this typically does mean, though, is that our upside is then limited, right? So if we're putting in a floor at 0, maybe the amount of interest that I can credit on the upside is going to be limited, likely higher than what I would have gotten out of the fixed annuity, but lower than, let's say, full 100% stock market participation. And there's a number of different interest crediting strategies that are available within these fixed indexed annuities. And I think that's too lengthy for us to get into in today's video. But I will tell you one, which is the most common interest crediting strategy that you'll see on a fixed indexed annuity, and that's called the annual point-to-point cap. And so what will happen is they will issue a cap rate on that particular policy. It might be something like, let's just say it's 9%. And the index that it's tracking, commonly the S&P 500 index, is going to essentially be the indicator that tells us how much interest that policy would credit. So if the S&P 500 index over the course of the year, and they're looking at point to point, day one of the year, right, and 365 days later. So if your policy issued on June 1st, right, it's June 1st, 1 year later, and that's what they're measuring. If the S&P was up, let's say 15%, and you have a cap at 9, well, you earned all the way up to that 9% cap. If the S&P was down 20%, you earned 0. If it was up, let's say 5%, you would earn the full 5% because you haven't hit your 9% cap or ceiling yet at this point in time. Okay, and then we're going to move on to the last of those three options that we talked about. In this case, the variable annuity contract. Now, a variable annuity contract will hold sub-accounts, very similar to mutual funds that you would see inside of something like a 401k. There will typically be a whole list of options of sub-accounts that you can choose from to be invested in. And that will range from aggressive options all the way down to very conservative, let's say bond-like funds, or possibly even a fixed account that's in there, which will be very, very safe, very similar to like a money market account or savings account. And you could divide your fund. I could put 10% into one strategy and 15% into another one of these sub accounts and 20% into another one. So I can choose to change my allocation in there and even have it actively managed by my financial advisor if I like. Typically, variable annuities will have internal fees that we might be paying. You know, those sub accounts themselves will have some internal expenses that you pay. And then oftentimes the advisor is going to have some type of an advisory fee as well that's attached to that account. Now, this is a fairly detailed and yet still broad stroke summary of all the different types of annuities that are out there, but I hope it helps to give you a good understanding at their core of at least the different types of annuities that are available. Something I think is really important for us to understand is that there are additional features that are they're called riders that can be added to most of these contracts that will do things like provide guaranteed lifetime income, provide maybe some type of a leveraged death benefit, possibly provide long-term care type privileges. There's all sorts of different riders that can be added to these policies that can help them maybe do something very specific for whoever it is that's purchasing that policy. With that, if you have additional questions, I would encourage you to reach out to us at Apriem Advisors. You're welcome to reach out to me directly. You can find all of our contact information on the website at apriem.com, and we look forward to seeing you next time.